Good afternoon. Todd Engelhardt, Regional Director of Investments, Cumberland Advisors, standing in for Matt McAleer. It is Friday, September 23, shortly before the close. There is no easy way to say this. It was a very trying week in the capital markets. The markets continue to struggle, digesting the magnitude of the Federal Reserve's inflation fight and the future possibility or probability for meaningful recession in the United States. Markets remain anxious about ongoing monetary tightening, higher yields, softening growth, and falling PE multiples. The Fed is trying to stomp inflation by reducing economic demand, which is clearly hurting the stock market. The numbers, the Dow Jones Industrial Average, the S&P 500, and the NASDAQ are all down by approximately 5% on the week. The bond market also took a meaningful but less severe hit. Just for perspective, the Standard & Poor's 500 index is down approximately 10% just since Federal Reserve Chairman Powell's comments in Jackson Hole, where he spoke of the need for firmer measures to fight domestic inflation. With that commentary, the market remains ultra sensitive to economic news, with most things reported being viewed in a slightly more negative light. The sharp pullback over these past 4 weeks is a result of a waning feeling that inflation is not dampening quickly enough and the possibility of recession becoming significant rather than mild. The mid-September month-over-month inflation reading was 0.2 higher than the 0.1% reduction that was forecast. Clearly, this news did not help the markets. The Fed on Wednesday maintained its aggressive stance, announcing another 75 basis point rate hike, predicting to bring short-term rates to as high as 4.4% by the end of 2022. Other central banks worldwide followed the Fed's lead, implementing their own sizable and meaningful hikes. To be sure, U.S. inflation is declining more slowly than the market had anticipated, but it is dropping nonetheless. In navigating this market, the value equity names have performed less negatively than the growth names. As the graphic shows, the U.S. industry sectors that are inherently more conservative, such as consumer staples, utilities, and healthcare, weathered the storm better than most. Overall, investors have been rewarded for being patient. Matt has preached patience during these videos. Cumberland continues to hold a very defensive cash position in several of its strategies. We'll continue to look for solid balance sheets, cash-generating names, and industries to put money to work in. But for now, we need to find some simple price stabilization since we've been punished for buying any kind of rally. These are times when investors need to have confidence in their asset allocation, their mix between stocks, bonds, and cash. A proper asset mix that aligns with your aspirations and your risk tolerance is indeed your blueprint. Hopefully you're enduring this market period with an asset mix that suits you. Over this trying period, stock valuations have compressed and the economy is indeed slowing, but hopefully not too much, which will allow the market to find a bottom. We're now going to toss it over to John Mousseau, who is taping remotely this week.
Hi, it's John Mousseau. It's Friday afternoon on September 23rd. I'm the CEO of Cumberland Advisors. Very tough week in bonds. Those of you of a certain age remember the old saying on TV, when E.F. Hutton talks, people listen. Well, when Jerome Powell, chairman of the Fed, talks, the bond markets listen. And he gave no doubt that they are going to continue to raise short-term interest rates. They raised them 75 basis points this week, so the upper end is now at 325. Certainly another 75 is coming, and you're probably looking at being over 4% by the end of the year on short-term rates. The front end of the yield curve doesn't wait for the Fed, it starts going. So basically the 2-year Treasury is now at a 420, the 5-year Treasury is at a 395, the 10-year Treasury is at a 370, and the 30-year Treasury is at a 360. A totally downward sloping yield curve from 2s out to 30s. It's been a long time since we've seen it this steep in terms of being negative. You've heard me talk about how this usually doesn't portend a recession. It helps cause them by banks having trouble lending and making money, lending short and borrowing short and lending long. This time is no different. Certainly we've seen it being taken out in the stock market. My colleague Todd, filling in for Matt, talked about that this week. What does this mean for Munis? Munis also got kicked in the shins this week. Pretty much the same as Treasuries, not worse. And essentially most Munis are yielding somewhere around 75% or so of Treasuries in the front end and are cheaper than Treasuries in the long end, and very cheap, certainly in terms of long bonds coming to market, 30-year bonds, which are between 4.5% and 5%. And could we see crack 5%? Yes. Do we think if it happens it's a buy? Absolutely. I mean, we think 4.5 is a buy. We think 4.20 is a buy, particularly when the long Treasuries are at 3 and change. Just to give you a little talk here, I am at the Amtrak station in Lorton, Virginia. It is a place where the auto train departs from going to Florida. We're going back to Sarasota, and it's pretty good. You have a sleeper car on the train. I wouldn't confuse it with the 20th Century Limited, those of you who remember the movie North by Northwest, but it's pretty darn nice. And one more sign that the infrastructure that the country needs, and we'll see it with bills that are out there and more money coming into infrastructure. And the country certainly needs it in terms of its railroads and its highways, dams, rivers, ports, etc. So we applaud any efforts on those levels. We'll keep you informed next week. Certainly the bond market got kicked in the shins, but if you looked at today's action in bonds, it's really a reflection that there's a lot of concern out there, particularly in stocks. So it wouldn't surprise us to see more asset allocation moving from stocks into bonds. We hope everybody has a great week. Thanks a lot.
Thank you, John. It's been a busy week. We have plenty to keep our eyes on. Don't forget to like, comment, and subscribe so you can follow along with our weekly videos. Have a restful weekend.